welcome to another Africa Hospitality Investment Forum podcast, the AHIF podcast, which looks to spread a little light and insight into the African continent and all that is hotel investment related. I'm here with Wayne Godwin, the co-CEO of JLL in Africa. Wayne, welcome, and looking forward to today.
Thank you, Matt. Looking forward to it, and definitely looking forward to the month ahead as we gear up to AHIF coming up soon, and looking forward to being with everyone in Namibia.
Yeah, 1 month to go, and we're really ramping up at the moment. Yesterday we did a cracking webinar. Today we're doing a podcast, so it's starting to get busy. For those that don't know, obviously JLL, which I imagine is very few, tell us a little bit about the organisation, but more importantly, what you're doing on the continent and the type of work that you're doing in Africa.
Sure. So, big picture, JLL is a Fortune 500 company listed on the New York Stock Exchange with around 100,000 people, really advising on all aspects of real estate. Now, within that, obviously, hospitality is a key component and what we're discussing today. But our activities are really sort of a mini ecosystem of the broader JLL services, right? So it's advisory. We help a lot on operator selection and contract negotiation. We do hotel valuations. We do transactions, both on the buy side and sell side. We help investors with investment strategy. And most notably, we're also doing a lot of work in the project management space, project and cost management space. So those are activities that are not limited only to hospitality, but we have a dedicated team and a dedicated team of about 25 people for Middle East and Africa, about 12 of those on the African continent, dedicated to that full service life cycle of hotel ownership from that perspective. So, yeah, I think that hopefully gives a bit of flavor for JLL and particularly JLL hotels.
So, at the moment, how are things looking for the African market? Is that pushing you towards any certain? You mentioned their project work, so is that different to other markets?
Yeah, listen, I think we're at quite an interesting stage of the recovery and the overall let's call it cycle. We've very much come through that COVID period, and through that period, we did still see a lot of transaction activity. In fact, even a bit higher than 2019. Maybe not quite at peak levels, but certainly 2021, 2022, 2023 were very good transaction volumes. Now, those transactions were being concluded by, let's call it a smaller group of buyers. And we definitely saw a bit of an augmentation of that capital, a bit more focused on private equity, a little bit less focused on the owner-operator side and private capital, but definitely been more of a buyer versus developer market the last few years. Now, historically, of course, Africa is very much a developmental market. So most of the capital, so when we talk hotel investment, actually the majority of that is into development. And even through this period, development has still been the primary, let's say, deployment mechanism or activity. Really, it's just the ratios have kind of changed a little bit more in favor of the acquisition side, right? And I think that really makes sense if we think about the fundamentals. On the development side, costs have gone up, but on the existing asset side or the acquisitions, the challenges that COVID-19 brought, impact on balance sheets, distress from a sector perspective, that's brought about more buying opportunities. And more liquidity there. So where do we kind of stand now and then going forward? I think things are kind of going a bit more back to that equilibrium, but there's still more buyers coming back into the mix, those that were active before 2019 that haven't been active the last few years. They're starting to relook at the sector, and that's positive on the acquisition side. on the development side is also broadening a bit again. That development cost increase that we was touched on, and we'll speak a bit more about it through the course of this discussion, because it's really sort of a key element driving investment at the moment. That is obviously still very high, but it has kind of tapered, right? So there's definitely more prospecting interest, development interest again. Obviously, the key challenge for the development side is also access to capital. Lenders are pretty conservative at this point around the asset class. They're very much concentrating on strong promoters, those that have broader balance sheets that they can stand behind. But we're certainly seeing the DFIs starting to get active again, and it often is the case where it's lenders are very against the sector, and then they're not, and then it's okay, and it starts moving again. And I think that's where we sort of headed the next 2-3 years, not where there's going to be this exuberant level of capital, and I think that's not necessarily a bad thing from a development side. A lot of what the narrative was before 2019 was, this supply and demand imbalance that markets would sometimes face. So I think we'll touch on that a bit more through today, but I think we're headed into a period where there could be less development and investment in the next 3-4 years. And as supporters of hotel investment, that doesn't sound like a good thing, but we actually think it's a positive thing, because the market and owners are going to enjoy a stronger story when it comes to performance. Banks are going to enjoy a stronger story because there's less new supply coming in, and it's gonna become a better blueprint for the sector and a better story for investment more longer term, versus a flood of capital in big new development pipeline. Everyone thinks it's great, and then performance is down as a result of oversupply. So that's in a nutshell. But obviously, a lot to still unpack from that.
And a couple of things come to mind. The first one was the banks and lending. It's obviously been a big issue for the sector, full stop. And in the webinar yesterday, it was brought up. A very good example was given in South Africa, specifically. Obviously, first wave was post the football, and then there was an oversupply, and the banks got burnt, and then they started to pick up confidence, and then you had COVID, and obviously you alluded to sort of coming out of COVID and these sort of fundamentals today. So if it's now going to be less sort of development in Africa, where do you sort of see the opportunities for those trying to break in, and or those who are already in? Where does this lead then for the next 2 to 3 years?
Yeah, let me maybe frame it like this. A first-time developer who's never had experience in the sector, who doesn't really have the full capital needed, but knows they want to do a hotel. That's not a great space to really be at this point, where I think historically there may have been more support from the lender community around that side. However, those that do have assets, have built sort of portfolios, have that experience in developing and able to kind of replicate that into other assets within their market, within the region, they're going to be very well placed, because one, there will still be distress coming through the system. I think it's very much a lagged kind of process, offset and kind of kickstarted, I guess, by COVID. But a lot of these, I think a lot of the discussions from a distress side is only really starting to come through now. So those with capital, those with experience, and those with comfort around the asset class are in a very good space, actually, because not only that fund what I've just said now, but on the other side, you don't have to contend with that more, I guess, exuberant level of kind of new supply that can come on your doorstep, even if the market fundamentals are not that great for it. So that less supply bodes well for existing assets, and it bodes well for experienced developers who can pick the right street corners, have the right partners, well capitalized, aren't going to take 7 to 10 years to develop their hotel. That's I think really strong position to be in, which is a direct result really from the last 3-4 years of headwinds that we've had.
And one of those headwinds is obviously this increased construction cost. Is that the main
Yeah.
driver, or what are you seeing cost sort of increases looking like? And is it across the board, or is it per individual market?
It is, and I think what we've got to be careful about is kind of segmenting development and acquisition, as acquisition equals don't worry about the construction cost, and development means that's now a big barrier. Almost to the contrary, where we've seen a lot of assets that need to be that are available to acquire, there's still capex required, right? And I think that's the portion of the overall costs which have seen quite high escalations. So it's really kind of impacted the sector from an investment perspective at every level. Of course, everywhere else in the world. But a lot of the acquisition opportunities in Africa are a bit older. They haven't had that much capex the last few years because of COVID and the need to sort of take some of that FF&E reserves, etc., and use that for working capital. So that is a challenge that the sector is facing. But now that's somewhere where banks can be quite smart. I think we're seeing an overall sophistication of lenders into Africa. We're seeing more MES coming in. We're seeing, and that's also something for operators to be quite creative around. If there's a lot of assets that are great, fantastic assets, but they're just a little bit tired, need some capex, and yes, that has seen high cost increases. The ability to fund those gaps is where I think there's a big opportunity. For on the lending side,
lot of opportunities in conversion.
Yeah, because I think that's where you've got an opportunity to really kind of get some incremental yield in a market where you're not seeing the same levels of new supply coming in. But of course, that's a very general statement. Of course, every market is very different. I'm in Nairobi, and the number of new hotels opening at the moment in the next the last 3 months and the next 6 months is quite significant. So, it is a market by market, opportunities assessment. But I think on the whole, the fundamentals are leading to a little bit less new supply, but that means stronger performance. And that means a better thesis and outcome and blueprint for the sector, into the longer term.
There's a lot of talk at the moment from when we come out of the Saudi conference that we just ran around branded residencies. At the moment, this seems to be very hot across the board, obviously Middle East especially. How does that particular product appear against or as an opportunity against something like the leisure product, which is also being touted as sort of a real opportunity at the moment? Obviously, it depends on city, country, all of that sort of stuff. But are you seeing sort of these as still opportunities in certain, or again, is it just blanket sort of acquisition? And the final piece of it is mixed use. If it fits into that, are there still opportunities in real estate projects, or where would you sort of be looking?
Yeah, okay. Look, I think branded residence, broadly speaking, is very nascent within Africa, and absolutely is going to become a very mainstream product and a lot of growth opportunity. I think it does sort of really depend market by market, and what is the orientation and the thesis of that branded residence? Is it a more primary residential play, right, where the brand is to uplift the price and put a premium on living in that, in that facility, but also with those services that come with that. Now, that tends to be stronger, well, and it tends to be more of an opportunity in strong, buoyant residential markets. And it's almost disconnected from the hotel fundamentals from that perspective. And we tend to see that more at the sort of upscale to luxury side of the market. And yeah, I think there are definitely pockets where there are good opportunities for that, particularly where you've got sort of an international, residential buyer pool. I think Cape Town is one of those, but we also see good interest in the likes of Nigeria and parts of West Africa, where it's there's good levels of appetite for that. Then the alternative, and I think that's quite an interesting one now, where it's more of a funding mechanism to develop a traditional hotel. So there'll be a rental pool, but buyers are not buying brand residences so much to live in them. There may be a hybrid of the two, where you get some residential rights or vacation rights, but principally you're buying it for an investment, right? That I think can still be a good mechanism. It's got to be done really well. I think there's a bit of hesitancy in parts of the continent around some of these schemes, and that's really a case of others that have come before them that have maybe not materialized, or people who've been burnt. But generally speaking, there's no reason why that can't be a strong, development mechanism. We're seeing quite a bit of interest in that in the Indian Ocean. There's the Apart Hotel scheme in Mauritius, and a few others that I think we're going to start to see a lot more of this hybridization between residential and hotels. And it's not only sort of a good funding mechanism, but also, it does really kind of enhance the overall residential product.
And the leisure market, we're hearing a lot about that globally, and obviously post-COVID sort of reaction to it. Is there opportunity there? Is slowing things down with the cost still?
Yeah, absolutely. I think that has been one of the real kind of standout areas the last year or two, maybe three, for stronger recovery, more investor appetite, I think, for the leisure segment. Once we got through that initial COVID impact and challenges that obviously was pretty, it lasted with the leisure segments probably a little bit longer, but then that recovery came through very strong. And yeah, we're absolutely seeing Africa being, I guess, holding, coming out quite strongly as a destination. A lot of things to still be done to improve that. But I think, a lot of, particularly the Indian Ocean, I think we're seeing a good story in the safari circuits, generally quite strong. Cape Town's had a phenomenal year or so on the leisure side. And a lot of it is also, a lot of currency weakness has made these destinations a lot more affordable, and really kind of helped in a world which has become quite expensive. I mean, anyone who's sort of taken a holiday in Europe or many of the other parts of the world knows this, just how expensive it has become. So I think Africa's been a net beneficiary of some of that cost of living increase when it comes to our leisure tourism sector, which is also, not something that, you can kind of replicate anywhere else. You can't go do a safari in in France. It's just one of those things never going to happen. So I think it has been a good story. We're seeing, but I think the question for investors is a little bit around the resort side. They get, and I think the large side is more what is the commercial mechanism to sort of really kind of get into the asset class in a big way. That by nature they have to be quite small and private, particularly at the higher end. That's just the DNA of the asset class. So I think investors are very curious, very interested. We're having a lot of discussions with some of our larger global clients about the asset class and entry, but they're trying to get their head around, okay, well, if we come in, how many is it? What is that investment thesis? How do we actually kind of scale it properly? Yeah, exactly.
Yeah.
But yeah, I mean, we're busy with a few things in Vic Falls, Botswana, Cape Town. These are all leisure type opportunities. The Seychelles, Mauritius. I would say probably 70% of the work we've been doing in the last year has been leisure versus corporate focused hotels.
What's how are the operators reacting to all of this? Obviously, hunting for conversion first, but what are they doing that might surprise you in some ways, or are they all sort of doing the same thing?
Look, I mean, I think they all are broadly doing the same thing in respect of bringing the much needed expertise and the brand and the story that is needed from them. I think within each of them, there's obviously nuances in the approach and all the rest. But I think it's very much similar to before, and obviously also in other parts of the world. I think there's still good growth for them. In the short term and medium term, probably being a bit more flexible on development costs, and I think we absolutely have seen that, right, in terms of being a bit more flexible to certain elements of the development that really kind of push up the price, whether it's a square meter here on a room or these sort of things. So I would say they've really come to the party quite well, but it wasn't enough to sort of counter those macro issues, headwinds and inflation, which obviously there was nothing that's a still net increase in costs. But I think there is an overall more flexible approach to the continent. Also, when you look at the brands that have come in within the brand stables and where they're sort of pushing, they tend to be more flexible and adaptive type brands, which is positive. And then of course, on the local and regional operators, I think many of those were quite focused on being owner operators before COVID, and I think one of the key themes coming out of them is a sort of shift to being more asset light, but still with good balance sheets, still with quite an owner-centric view. And I think there's a good opportunity in context of the sort of broader good story that we spoke about from a performance point of view, for them to take a bit more risk, not necessarily investing, but maybe we start to see more leases come into play, and other ways to give comfort to investors to unlock opportunities for them. So I think there's a good opportunity for the local and regional operators to accelerate their growth the next few years, and probably get to the same point as they were hoping to, even if they were hoping to remain owner operators and investing for probably a little bit longer than what we've seen. So I think overall a good story. We're seeing a lot more interest from new operators. I think quite a few of the Spanish and French operators and European operators are starting to be more interested in Africa, and that's overall a good thing.
Yeah, I agree. So finally, then, in summary of all of it, what would your sort of advice on strategies be to drive yields over the next 2 to 3 years? What in a sort of nutshell, what would you be advising your clients on?
So yeah, I mean, I think there's going to be investors that are very laser focused on that those kind of distressed opportunities. There's going to be those that are going to be looking for those assets that are good assets, but bit of not quite distressed, but certainly not capital to do refurbishments and kind of get them to the level they need to be. I think there'll be investors that are quite targeted at that. Bringing in $1 million here, $5 million there, maybe $10 million max, but that can unlock a lot of opportunities in terms of a lot of the current hotels. And then I think on the owner operator side, I think there's good growth fundamentals for them. And then I think we'll see more of the international operators in the leisure space, where historically I think they brought a lot more comfort in the corporate hotel space. So I actually think it's could be a good few years for the sector if we take a sort of 5-year horizon. Obviously, every market, every street corner is going to be different. It's not a homogenous story, but I think we'll see a bit of a maturity come into the sector, and we'll see less sort of first-time inexperienced developers and less projects announced that sit there and stand there for 5-10 years, and eventually, I think that's a good thing, because when investors look at it, global investors, and they look at the pipelines and they see, wow, this is how's these markets going to ever absorb all this, and the reality is it's only a sort of fraction of it that does come in. They look at average, how long does it take to develop a hotel, and it's 5-6 years, but there's those that are kind of experienced in doing it in a year and a half. So it's really sort of I guess cleaning up that story from an investment perspective. I mean, hotels in Africa, often that sort of 65% mark is sometimes, in many cases, considered a good mark. But the reality is, got to be pushing that quite a bit higher, and that's a global norm. So I think that it's changing that baseline expectations of what the sector should deliver. That is what's required, and I think we can go through that evolution over the next 5 years for sure.
Well, thank you, and thanks for all your thoughts, knowledge, and advice. Wayne, thank you for joining us today on the podcast, and look forward to seeing you in a month's time.
Yeah, absolutely. Looking forward to it.
Thanks, Wayne.
Thank you for tuning in. For more information, visit our website at www.ahif.com.